you'll see here that the key to trading is about recognizing the reaction to liquidity, and not liquidity, to activity. The delta, the key levels, the volume, the voltics, the data, the time and the value all create reactions that can be analyzed and traded. Your job is to get to the grips with the reaction and trade accordingly. In other words, start looking to see what they did with the stuff. And what stuff are we talking about? Liquidity. We're talking about key liquidities. What did they use the liquidity for? We talked about that with the durable goods today. They bought those durable goods numbers, not that it did them much good, but they bought the durable goods numbers suggesting that there might have been a buy response at the cash open, and there was. It was only worth $300, but it was still a buy response, right? Add in the low volatility, the high volatility understanding, which we covered in classroom yesterday. And did dealers buy the highs or sell the highs? For example, did they buy into bad data? For example, how did they trade the break of a key level? Did they buy the break or did they sell the break? Are they doing mean reversion or are they doing volatility extension? It's got to be one or t'other of those two outcomes, hasn't it? Each of these ideas gives a tradable opportunity for you to exploit. And the key one is the big board. Get the big board right, and everything else falls into place. So let's take a look at what we thought about the big board. Oil. We couldn't really get much more accurate on last night's message. It was a perfect trade. And then into today, the demand-sided drivers are still in play. Remember, this is last night, oil. This is London time, 11 o'clock last night. So in other words, it's after the US cash close. It's into the overnight session, so it's into the Asia Pacific session. So we've got an idea here that the demand drivers are still very much in play. You can see that for yourself. We covered it in class. So it's important for the bulls to hold the RGL. What price was oil's RGL last night? Oil RGL at 11 o'clock, you can see it for yourself. Oil RGL was 90.35 to 90.45. Everybody happy with that? 90.35 to 90.45 is this banded blue line here. So what did we say about that? It's important for the bulls to hold the RGL. If they don't, we're going to sweep into these areas of the 90s, the 89.25s, or the 88.50s. So we've got some target prices for the sell. So if the price goes offered at 35, we're going to sweep 90 without any question. And if we sweep 90, there's a fair chance we're going to sweep 89.25. So the market has this ability to move from point to point because that's the concept of the dealer pricing, if you remember. So when we understand that, if the market turns, so watch if the RGL turns red. The RGL never turned red, did it? Not once. The RGL stayed blue. 90.35, 90.45, buy side above, sell side below. But it wasn't just that, was it? It was the fact that we had demand-sided business. We knew that we had demand-sided business because we covered this in classroom yesterday. We had about $1.60, Paul. So about a $1.30, $1.40, $1.50 during the day. We had these dollar demand ideas that this oil price really was wanting to be buy side today, and it was improving as well in the overnight session. So as it improves in the overnight session, of course, as we trade back towards the $90.45, and it starts rotating back out of $90.45, the question is, reminder what the question is? What do they do with the key levels? What do they do with the RGLs? We don't know what they're going to do. At this stage, we have got no way of knowing what they're going to do until we start applying some R-squared ideas, until we start applying some auction ideas. We've got no way of knowing what they're going to do. So what we've got to make sure is we start watching for the reaction. And as you can see at about 11 o'clock London last night, they started to buy off the RGL. They started to bid back out of the RGL, giving you your buy signal, allowing you to now go long buy side RGLs off the 45 RGL price. 90.45. What price was it this morning? Remind me. $92.40. It was nearly worth $2,000. Simply to take that tweet and then trade the tweet. Take the tweet and trade the tweet $2,000 a contract from last night. Whilst you guys in the States are all in Snoozeville, Tennessee, you could be making a fortune with a stop at 90.35, couldn't you? With a stop at 90.35, you could simply have then says, you know what, that's pretty good. I could make $2,000 on that one. 10-tick stop, $2,000 profit. Beautiful. This is the concept of getting out of your own way. It's one of the biggest problems that retail traders have, is they get in their own way. You get so many opportunities to buy and sell into the good stuff. But no, you want to make it harder for yourself. You want to make it really difficult by selling top edges every day and buying bottom edges every day, instead of just getting out of your own way and getting that deal done. You think, oh, I'm going to be a superstar, and you come in here and you start selling in here, and then you sell in this rally, and then you'll sell up here, and then you'll sell more here. You'll try again here, you'll try again here, and meanwhile, you've lost 10 out of the last 10 trades. And then you get a winner, but because you've lost 10 out of 10 last trades, you treat your stops at break even plus 1, and you get a 1-tick profit. So you win 1 trade out of 10 for a tick, and you've lost 9 out of 10 trades for 10 ticks each, because you're in your own bloody way. Get out. Step aside from yourself and allow the price to show you what you're supposed to be doing. Allow the value to show you what you're supposed to be doing. Get out of your own way for a change and let the charts show you. Let the value show you. Let the auction show you. Because then obviously by the time we got into the London Open, we're obviously still very blue. We're still very green, whatever color you like. I prefer blue to green, but that's my preference. But it's obviously an RGL. It's not the big board. The big board is this price right here, 90.35, 90.45. That's the big board. And then we go back in again and we buy some more. When we buy some more, we're obviously now exposed to this very impressive looking developing chart, aren't we? So we've obviously developed out the chart idea from this oil classroom yesterday. We started to talk about it. And we started to talk about these auctions. And this is from the London Open now at this stage, right? So we get rid of this. On 2 occasions, we actually had bidders' auctions. What is a bidders' auction? A bidders' auction is where there's a lot of sellers that are finding a lot of buyers willing to pay money at higher prices, willing to buy at higher prices. We need to know what kind of auction we're in. If we don't know what kind of auction we're in, how do we know what price to pay for it? If we're in a bidder's auction, we should be willing to pay a good price. We should be willing to cross the spreads. If we're in a seller's auction, we should be willing to wait for the best possible price. So we need to know what kind of auction it is. Simple as that. We need to know this stuff. So when we look at whether we've got a supply or demand idea developing, is there anybody that doesn't believe we have a demand marketplace? Is there anybody that can't draw a reg line through that and say, well, I'm still very much in demand here? You see it? It's crystal fucking clear. We want to be buying into these liquidity pools, into these bidders' auction areas. We want to be busy with these deals. So obviously that's really, really, really clear. So as we come up into the top edge, did that storyline start to change? Yes, it is. We started to see if we draw a reg line through that phase there, we can recognize that there is a substantial opportunity to fade into the top edge. But guess what? It's a fade into the top edge. We are the weak traders now. So because we are the weak-handed traders, we've got to be really cautious about selling any top edges. So when you think about those as trades, we think about the idea of these trades. There's a lot of other trades on the screen, isn't there? What other trades can we do as particular trade setups? Well, take a look at these ones in here. You'll see every now and then there's a little line here called bids. There's a little line here called bids. And there's a little line here called bids. Now, what are they trades? What are they all about? Well, for a lot of people, these actually should be your bread and butter type trades. If you remember the intern's exercise, the intern's exercise is to preferably go with the color of the big board. Now, there's a couple of things that we have to understand about the big board as well. One of the biggest challenges, of course, is that when we come into a top edge, any real top edge up here, there's always a chance what you're going to find is there's going to be a big commercial seller resting just above the top edge here. So they'll sell to any buy side liquidity, and the price gets snapped up really, really quickly. So the best way to deal in these types of things is to watch these little phases where we come into maybe a spring trade. Maybe let's just assume we get a spring trade here to get a little bit of space. And then we get a little one candle pitch here, one or two candle pitch here. And what happens there is, of course, if I buy into that, I'm not going to be buying into commercial selling, because the commercial selling will exist up here, right? It's not going to exist here unless we're really, really unlucky. So if we can buy into this little fella here, it's a little bit of tipping price. It's a little bit of intern. It's a little bit of BSG squeeze. It's got all the key elements, but at a far better price point. It's still in the blue market. It's still RGL buy side. So we're only going to be doing this in the direction of the flow of traffic. So the clear flow of traffic is blue in color. Blue is the color. Football is the game. And of course, we can obviously recognize where these trades take place. There's a little dark green candle there. That's what we're looking for. It should be just above the halfway stage. It should not be at the top edges. So when we see that little green candle there, this is a really powerful interns buy trade right there. Target price, top edge. Does it make a lot of money? Well, if you'd bought that little break there at 48s, it trades 62s. It's a profit, isn't it? 14 ticks, $140. Pretty good. It's okay. Better than a kick in the chops, isn't it? So then we get another one. We get another little green candle here. You might be saying, but Ray, wait a second. You're cherry picking. What about this green candle here or this green candle? Well, what did I just tell you? If you buy back above those green candles, you're going right into the top edge where a commercial trader might be operating. So you can't buy back into the top edge at that stage. You might be buying right into a commercial trader selling oil at those higher prices. So it really wants to be in this kind of area here. Do you see how it's just above the 50 point, but well below the top edge? And obviously, if you get a breaker, you're in good shape. So if I was to say to you, why was that not a trade there? You'd now know the answer, correct? Because this is into a fresh commercial trade area high. This is going to be very, very tough at this stage. It's very tough to be a buyer there. Because obviously, if you're a buyer into that, that means you're buying basically the high of the day. That's never a good thing to do. Some people might disagree in the equity space, but these are the guys that buy and hold stocks for like 25 years and hope for the best, right? So we don't want to buy day highs. We don't want to be the buyer into this price here. We can always do better than that. There's always the chance that a commercial will swoop in and start selling straight into your buying and you've got no chance, right? So where is the trade? Well, remember the rules. It needs to be above 50%. Why does it need to be above 50%, guys? Why does the bid here need to be above 50% of the swing? Why does the bid here need to be above 50% of the swing? Because we want to put the odds back in our favor. We want to put the tipping price back in our favor. And it reminds us, of course, of the tipping price trade and this idea of the profile dudes who like the idea of these distributions, right? So we've got the profile dudes coming in here and saying, well, there's your profile. Now, when did the sellers get put under pressure on that profile? At what point do the sellers get put under pressure? They get put under pressure as soon as the price goes above the POC. Because at that stage, statistically, the sellers are now the losers. The net losers are now the short sellers, correct? If you buy into this area here, it's the buyers that are the losers at the moment. The sellers are on the strong hand, and you're on a weak hand. You don't want to be in a weak hand when you're a momentum trader. You need to be on a strong hand to trade momentum. So if we're going to buy in the narrative here, this is going to be our play. This is going to be the play here. It's got to be above that level. Now, you could do POCs, and you don't need to. You can simply just eyeball it. You'll know roughly that you're right if you eyeball it. So do we all agree that this buy order here was well above the POC of that balance? Check it for yourself if you have such an inclination to do so. Can we all agree that that buy is above the POC of that big balance area? Again, check it if you need to know it. Now, in this area here, Does everybody now see why that's not the buy trade there? Because if I put a buy trade against that little dark green candle, I'm below the POC at that stage, right? So that cannot be the trade at that point. It's not the right trade. So the right trade would be to buy it when we tip the price, and that puts in that beautiful squeeze where we get into a long trade about 86, and we end up trading back above 15, 16. So we end up with about a 30 tick profit on that press, worth around about $300 per contract. Beautiful bit of business, right? Beautiful bit of business. So when we understand this, you can always see these trades screaming at you. That's not a buy trade there because it's in the bottom half of the last bracket, isn't it? In the last bracket there, that's still below the bottom half. So that's going to be a tough gig there to get long. It worked out beautifully. That's okay. A better buy would have been here, but there's a challenge to a buy at that price, isn't it? You're almost buying into the day highs. You're almost buying into that guy there. The difference between the two prices is 5 ticks. There's still room. You're not going to have the commercial selling 5 ticks shy of that area. If they're at that price now, they're going to let it sweep, right? They're going to let that price sweep. And in addition to which, of course, you've got the 92.25 wholesale prices, which obviously is going to drag the flush price into the markets anyway. So really, you're about 10 ticks shy of that. So you could still probably get away with that one right there. I wouldn't be disagreeing with you if you decided that that was one of your press trades right there. I wouldn't be sitting there screaming at you saying, what the hell are you doing there at that price? It's a pretty good looking trade. And obviously from that point onwards, we started to see the failed auctions back into this flush. We got paycheck here into a flush price. Why is that a flush price? Because it runs the stops at 92. The 92 is your flush. You see that? So with a failed auction in the background here at 40, you were always looking for that flush price to buy into, and then the run back into liquidity at the top edges. Now let's take a look at these ideas. Let's take a look at some of these ones here. In yesterday's classroom, we talked about the Brent oil WTI. We talked about crack spreading. Let's take a look and see if any of these trades had any of the qualities that we talked about. The idea, of course, is we're buying the black line if it stands out crystal clear from the other lines. Let's take a look and see. Does anybody think any of those buy arrows had the black line standing out on any of our other spreads? What do you think? At this point here, is the black line going in the opposite direction from the purple line for the first time? Opposite direction from the purple line. The black line is going in the opposite direction from the red line. That's a buy trade. Boom. The black line's going in the opposite direction from the red and the blue line and the red line. This one's not quite as clear, but the red line's accelerating away from the black line. Remember, if we're buying the black lines, we're buying oil. We're selling the black line, we can be selling oil. If we can buy the black line in a blue marketplace on a red or green candle, you got all the colors lined up. You got a great deal. Can anybody agree that this trade looks unbelievably good? Look at the spread bubble forming. Look at the spread bubble forming here. It's completely the opposite direction. Look, it is a benchmark. It absolutely is a benchmark. Look at that. That is what we call a benchmark buy trade, especially if it starts tying in with the RGLs, if it ties in with volume. And some people say, but there's lots of benchmarks in that chart. Yeah, but we're looking for the buy side benchmarks. We're looking for those benchmarks that scream at us in the direction of the flow of the traffic so that we stop becoming the Darth Vader of the bottom edges or the top edges. So when we start seeing those elements, let's see if they flipped over for the top line shorts. Let's see if we spotted any elements into the top line. Do we agree that the black line is now premiumed against the red line here? They're not as good, they're not as clean, but they're definitely premiumed. They're definitely premiumed, aren't they? So we can obviously now recognize that this chart is looking pretty good. The storyline is looking pretty strong. the underlying idea looks like we are on our way to a good day on oil. Now, if we look at this in the background and we look at the overall view in this, look at how long this market's been blue. What do you think? The market's actually been blue since $88.80. Well, that means that this market hasn't really been a red market for $4,000 a contract. In other words, you could have been long for the last 48 hours and simply never have been taken out of your long positions for 48 hours for $4,000 a contract. That's a nice way to make a living, isn't it? So what about the short sale that came in before that? How long did that play out? You see the market was solidly red from this point onwards at $90.50 all the way down to $88. And we end up with a $2,500 profit on the short sale. Beautiful, right? Absolutely stunningly beautiful. So we're obviously looking at these from these longer term perspectives. You know, we want to make sure when we look at these as trades, what we're trying to do is we're trying to figure out what the underlying market is doing. We're trying to figure out what else we can see in terms of these ideas. We want to be buying when it's blue. We absolutely want to be buying when it's blue. It should be nearly impossible for you to sell when it's blue. Not impossible, nearly impossible. And that's what's proving to be the case. All of these buy trades and a few sell trades at top edges, allowing us to make the right reads at the right prices all the way through that entire process. So when you look at that one, and you look at our oil trades and you think about how we've done on these deals, and we've looked at the 2-year linkers, for example, and we look at how the bond trade is done since this buy trade came in from that drop yesterday that we called in advance, and then we sold into the top edge when the market broke south out of here. The idea is that when you get these structures, and the structure can come from anywhere, we've talked about this before, you can get your structural trade anywhere. There's a lot of them. Cash opens, cash closes, volume spikes, Voltics, the buyers or sellers auctions. There's a lot of information where we can get this information, we can use it, right? We can get that information, we can start to use that information to make the call. Take a look at the NASDAQ. Take a look at the NASDAQ at the cash open. Let's grab a chart for you. What kind of auction did we get at the cash open? Now, this might be a little bit challenging because it's not that easy to spot it. But it's not actually that difficult to spot it either. If I was to draw this out on a paint board. Let me draw it on a paint board that might make it easier to see it. The question, of course, is where is the competition for orders? If you can figure out where the competition is, you can figure out what the trade will likely to be. Where is the competition? Okay, so this is the question that we're trying to answer pretty much in any of these big things like the cash opens or the cash closes or data releases or anything like this, right? Where is the competition? So let me draw price for you. Okay? Let me draw delta for you. And now answer the question, where is the auction? Where is the competition in this auction? Straight away, you know this is a short sale, right? Straight away, you look at that and you say, wait a second, short sellers are competing for these buy orders. So straight away, you look at that, you say to yourself, wait a second, this is now going to be a short sell. This market is going to go down from here. At least it should go down from this point. Do you agree? Well, we go back to this idea now and we think about what we're seeing. Now look at the NASDAQ and tell me the answer. There's the price high. So what do you think now? This is a seller's auction, correct? Yes or no? So now there's a lot of competition for those buyers. There's a massive amount of competition for those buyers, but we don't know if they're going to rotate it at this stage, do we? We've got no way of knowing yet that they're actually going to turn this price back sell side. We can look at the market depth and we can see that they are very definitely offering this. They're definitely absorbing it, and it's visible absorption. It's not just hidden absorption. It's not ice orders. There's no funny business going on. So we now know what kind of auction we're getting at the cash open. We're getting a very bearish auction, aren't we? We're getting a very bearish auction. So we can actually see that auction taking place in here at 795, can't we? So what are we going to do about it? We're going to start working this offer here at 795, aren't we? We're going to start working into that sell trade there. And what happens to the NASDAQ? The NASDAQ sells off. And it doesn't just sell off. It sells off by $1,600 inside of that period, which is approximately 25 minutes. Did we cover this in yesterday's classroom, yes or no? Yes, we did. So did everybody recognize it in the NASDAQ today? No, because you're too bloody lazy to recognize it. You're too scared to be found to be dealing against that auction. Because if you weren't too scared, you'd all be short and you'd all be making fortunes. Daniel's in it. Somebody's not scared. Somebody's put their head above the parapet and hope to be taking a shot at it. But where's all the other orders? Where's everybody else on this? Why are you not taking the shot? What are you missing? Why are you in your own way again? And what is it going to take for you to get out of your way? What is it going to take for you to get out of your own way and start using the information that's available? Is it just a lack of confidence? Something is what's stopping you as a trader. What is it? 9 times out of 10, it's just fear. I don't want to lose money. I don't want to lose money. It's just fear. So obviously that sell trade did very, very well indeed. It made a lot of monies. Nice outcome, right? Nice outcome. Yeah, but at some stage, Paul, you've got to say, when does the practice stop? At some stage, you've got perma students who never seem to get into live, never seem to do the right business, never seem to actually make the progress in a real trading environment because they become perma students. They would rather learn stuff than have to be found out about their knowledge. It's like the person who never does an exam so that they don't ever fail. You've got to do an exam. You've got to be looked to fail. It's part and parcel of trading. You've got to be willing to take the hit. You'll never be a trader if you're not able to deal with that kind of rejection or that kind of failure, because you're going to get failures. You're going to get lots of failures. You've got to take your shot. And you've got to have the tools and the abilities to take that shot, guys. The bond short, you've got to have the confidence to know that that's what the play is. And when the bond breaks here, you've got to have the confidence to know what the play is. Sell side RGL, get me involved. Sell side RGL, let's be short. Let's get the deal done. If you don't see it, there's no opportunity. If there's no auction, if there's no edge, there's no edge. You just let it go. And this is the important thing in trading, isn't it? By recognizing the edge. I mean, look at this trade here. How many people got the $92.80 on the numbers? How many people got that $92.80 on the numbers? There's the liquidity pool there. There was your flush price. You saw it before the data came out. You saw the storyline before the data came out. You saw the divergence. There was a bit of divergence. It's been diverging since $92.50. And you were able to get a sweep into that flush price. And then from that flush price, you were able to get a little run back out of the flush price at that stage. So when we look at that as a narrative and we start understanding that as a narrative, let's take a look at that flush price and see if there was any evidence of any auction taking place that might have been interesting. Does anybody see any auction that might have been interesting? Yes or no? What the hell is even that? Is that not a seller's auction? Is that there not a seller's auction? Is that red dash there not a lean price that you can come into and say, you know what, I can put my sell stop order in just right there? At that point right there, could I not just take that red block and put a sell stop order there and then see what happens? And did it make a lot of money? Did okay. The only challenge we've got is it seems as if the market maker's inventory got a little bit short here. So obviously there's an idea that that probably was your walk away at 52s. So when the price rejects off of that seller's auction there and it turns into an accumulation buy auction, then of course we just simply buy when it comes back off it to close out our position. So you use your stories, you use the narrative, you use the levels, you use the underlying ideas to try and figure this thing out. Every single piece of information is something that can give you an edge. Your job is to use those edges. And if there's no edge, your job is to stand aside and just wait. Just wait. Build a new storyline, get back to building the narrative. And in the professional world, all that ever happens is all we ever talk about in the professional world is building a narrative. If there's a narrative, we all know what it is. Our job now is to get the best volume, the best liquidity, the best price. Everybody knows what the narrative is. Sometimes you're selling it to go higher. Sometimes you're buying at higher prices because there's no sellers. That's all we're doing. What you've got to do is recognize what the narrative is and then recognize what the pros are doing with that narrative. Are they taking it down like Goldman Sachs yesterday to buy it? Are they taking it up because they can't take it down to buy it? In which case they'll try and cap it and hold it for the next phase, and then they'll take it down in the quiet phase overnight. Goldman's have the same problem today. They have got a brilliant sell opportunity on this as far as trading is concerned. They've got a brilliant sell on this. And obviously, based on that brilliant sell, Goldman's have found it really difficult on bonds to do this top line scenario. Too many sellers. So what Goldman's will do is this scenario here. They'll hold it down. And then in the overnight session, there's a very good chance that Goldman's will rotate it back up on the quiet volumes to accumulate the big size at higher prices in the Asia Pacific session. And what they'll then do is they'll mark it down at the London Open. It's Goldman Sachs written all over it. But even Goldman Sachs rely on the rest of the market to behave, to give them the orders that they need to fill their trades. And that's what the important thing is being able to recognize the model that's in place. How's that guy's calendar spread doing, by the way, guys? Not very well, if you ask me. You'd have thought with the oil getting that little bit of a sell play, you'd have thought the guy's calendar spread might have made some money, but that guy that put on that big block spread for 3 million, sitting with about a 14 grand loss at the moment. But I didn't think he took it for a scalp, Paul. What do you think? Do you think he was in it for 5 minutes? Or do you think he was in it for the next 48 hours? Probably taking a 48-hour view on this. So we've obviously got that big trade there for 3 million bucks. Guy's losing money at the moment, but he's obviously bearish. So let's see how it plays out over the next 48 hours, see if the guy makes any money. Be interesting, wouldn't it? It will be interesting. Okay, so what happened to the equity, guys? Well, obviously it was a bit disastrous. The challenge, of course, was the fact that we'd went 43.40 sell side. And as soon as we went 43.40 sell side, we knew that equities were in trouble. And the equities have been in trouble ever since. Let's take a look at the auctions that we saw coming in. Is there anybody got a view on the auction coming into the cash open again? It's the same auction again, isn't it? Same storyline. What does everybody think? Same storyline. It's a seller's auction. Does everybody agree? From the London session going forward that it's a seller's auction, yes or no? Yes? No? Yeah. So if it's a seller's auction, has anybody been able to take advantage of the fact that it's a seller's auction? Have you been predominantly working into these seller's auction price areas? Have you been predominantly looking at these as ideas to try and work into that short sell so that you can take advantage? There's a seller's auction in here. There's a competition for buy orders. And when there's a competition for buy orders, you know the price is going to go down. Not up like a lot of people in the retail space think, down. And that's what we've got. We've got that down move in the markets, haven't we? We've got that overall shape of the down move. When is the move going to move higher? When is the move going to move higher? Well, we don't know. No way of knowing. We just wait for them to start auctioning for the sell orders. And if it doesn't auction for the sell orders, they'll keep taking it down. Why? To get some bloody sellers. Because that's the only place they're going to get them, is if they can take the price down. Remember, it's done for a reason. There's a process. There's an underlying process on every commercial desk, and it's called the execution strategies. If I'm trying to get filled on a buy order, I need to find sellers. We do this question a lot in the retail space in webinars, don't we, Kim? We ask a lot of the times, if I'm a buyer, what do I need? And people say sellers. And you think to yourself, wow, if I'm already long, the question actually is, if I'm already long, what do I need to find? And everybody says sellers, don't they? Agreed? Everybody says sellers because I'm long. You don't want to find any sellers. If I find sellers, that's the exact opposite I want to, because I'm already long. I don't want to find sellers. I need to find buyers, and I need to find lots of them at higher prices, right? Because if I'm long, I'm going to be short. So I need to find buyers at higher prices. So obviously, if I'm looking to get long, the only thing I can get long against is a seller at lower prices. You get it? The only thing I can do is try and look for those sellers at lower prices. So we start looking for those auctions. We can see that there's a little bit of an auction starting in here just now. There's a little bit of an auction, but we want to make sure they absorb it and reverse it. So we can obviously look at this and say, well, they might run it through here because the selling at the moment is still having the desired effect. We can see that the macro is good on this at the moment. But this is going to be something that we're now going to be looking at as a probable buy-side reversal coming up. Might not develop, might develop, we don't know yet. All we got to do is get ready for that buy reversal. Make sense? Oil still better, by the way, guys. The oil supply line's actually flipped back round again. So if anybody's on the oil, it was good in the first initial phase, but it's doubled back on itself. Everybody see the change taking place in there? See it? See the change taking place there? It was in this green candle right there, wasn't it? Take the big green candle off there and see what happened on that candle there. Do you see it? That was the change candle right there. So all of a sudden, you might have went short on the flush here, but then when the change took place here, you're obviously getting ready now for the next sweep. And obviously getting ready for the next sweep is exactly what the price has now done at that stage. It's ran that beautifully through the top lines. A very, very, very strong sweep there. Nice.